Hey guys, and welcome back to the second episode of the 365 Days Forex series. In this video, I'm going to introduce you into the crazy wide world of trading, but out of the different types of financial markets that you can trade. So without further ado guys, make sure you smash that subscribe button and the like button, grab your notepad and get yourself comfy, and let's get into today's video. So, what actually is trading? Trading at its most basic level simply involves exchanging one thing for another. Most people take part in thousands of trades each year by exchanging their money for goods such as food and clothes. Often these goods have an intrinsic value based on what consumers are willing to pay for something. This is the reason that essentials such as bread and milk are priced similarly regardless of whether you go to Tesco or Sainsbury's. When taking your first steps in financial trading, there are a multitude of markets available to you, as well as a multitude of types of trading that you can do. Forex and FX are shortened terms for foreign exchange market. Possibly one of the most popular markets to trade over the past 40 years, the Forex market's volume has increased from a humble $5 billion in 1977 to almost $7 trillion as of early 2020. This exponential growth is the direct result of three main factors. The first factor is the transition from physical to digital exchanges, which means that anyone with a computer can begin taking part in financial transactions. Previously, you'd have to call your broker to execute trading transactions, and you'd be subject to large trading fees, but now you can simply execute orders through a laptop and begin participating. The second factor is the lower cost of computers and mobile devices. To put in perspective, the first general purpose computer sold for 250 grand, which is close to $2 million adjusted for today's value and inflation. Luckily, technology now is cheaper, so more people can access digital exchanges, and therefore the market volume increases as more and more participants begin putting their money into the market. The third factor is the increased accessibility of education materials and tools that can help you trade through the internet. Platforms like this, such as YouTube, provide endless opportunities to learn new skills and research topics that you wouldn't normally have had access to through traditional educational routes such as unis or college. As you've probably guessed, different markets generally attract different types of traders. And the Forex market has become extremely popular with traders who look to take shorter term trading opportunities, as the markets can be traded 24 hours a day, 5 days a week. This means that there are a lot of opportunities to make money within the market. However, one big caveat: where there are a lot of opportunities to make money, there are equally as many opportunities to lose money. So make sure that before you dive headfirst into any of the markets that I've discussed today, you actually understand how to manage your risk correctly before you blow your account up. As a side note guys, we will actually be covering risk management in a future video, so stay tuned for that and hit that notification bell. As well as Forex, beginners tend to gravitate towards the commodities market. The commodity market is composed of hard commodities such as gold and oil, as well as soft commodities such as agricultural and livestock products. It's often thought that beginners prefer trading this asset class due to being able to appraise whether an asset is overbought or oversold based on their personal opinion. This type of market has a variety of participants who take short, medium and long-term positions depending on their own style of trading. Longer-term traders will often trade commodities such as gold against the US dollar to hedge against inflation. This is due to the fact that inflation over a longer period of time is likely to increase, and the value of gold as a result of this will increase as well. Another popular market to trade is the derivatives market. The derivatives market includes instruments that are connected to an underlying asset, such as a commodity, and are sometimes used to hedge against price changes. Popular derivatives include futures and forward contracts. Let's look at an example. When a coffee shop wants to make a cup of black coffee, the main underlying ingredient is coffee beans. And this is what will affect how much profit they will make when producing that cup of coffee. Let's say the price of the coffee beans required to make the coffee is £1. The cafe sells this cup of coffee for £1.50, meaning that they make a profit of 50 pence per cup. If they want to ensure that they will always be able to maintain this profit margin regardless of whether the price of the coffee beans increases or decreases, they can use this by using a derivative tracking the price of coffee beans. In this example, let's imagine that the coffee shop believes that there will be a shortage of coffee beans which will affect the supply of coffee into the market, which as a result of that will increase the production costs of making the cup of coffee. The coffee shop are able to protect their profit margins by buying the derivative coffee beans when the price is at £1. And if the price of the coffee beans increases to £1.30, then they'll only make 20 pence profit when they sell a physical cup of coffee for £1.50. However, because the coffee shop also has a contract for the coffee beans, which was bought at £1, it will make 30 pence profit per contract. This means that regardless of what happens, they're able to protect their profit margin by making 20 pence from the physical sale and 30 pence from the sale of the contract, which totals 50 pence profit, the same amount seen in the first example. Looking at the reverse, if the price of the coffee beans decreased to 80 pence, then they would make a loss on the derivatives position of 20 pence per contract, but now they would make 70 pence per physical cup of coffee sold, and therefore this would still have the outcome of 50 pence profit per cup. Now let's take a look at capital markets. The capital markets can be split into two markets, and these markets include both public and private sectors, shares and bonds. The primary market is where companies and government issue new securities directly from the companies, and this process is often referred to as an initial public offering, sometimes just shortened to IPO. These stocks and bonds are often bought by hedge funds, mutual funds and investment banks, which are classified as institutional investors. The secondary market is where traders and investors can exchange existing securities which have already been issued. The New York Stock Exchange is an example of a secondary market and is regulated by the Securities and Exchange Commission. A less popular but important market to discuss is the insurance and mortgage markets. Mortgage markets revolve around longer term loans that are provided for buying properties. These loans can be traded on the secondary mortgage markets. You may have heard of the mortgage collapse in America in the mid to late 2000s, which is well documented in the film The Big Short. The insurance markets involve the insurance brokers, and this market transfers their risk for a premium. Insurance companies have a large cash reserve which they can then invest into stocks, bonds and the derivatives market. Another type of market is the money markets. Money markets are focused on very short-term debt and involve local and central banks. Banks loan to each other for a form of short-term liquidity, and the central bank will often act as a lender as a last resort, which is something we saw last year due to the coronavirus pandemic. Governments all around the world have been using the central banks during the coronavirus pandemic to help finance government initiatives such as the UK furlough scheme that we saw in the earlier periods of the coronavirus through to the late part of 2020. The last market we will discuss is the cryptocurrency markets. Although the crypto market is relatively new, Bitcoin and altcoins captured the headlines in 2017 when strong price volatility caused a massive surge in prices. The blockchain technology behind Bitcoin and the mining systems that can be used to attain cryptocurrencies and altcoins have resulted in a public interest in the cryptocurrency market. In mid-2020, the investment bank JP Morgan extended services to two very popular cryptocurrency exchanges, which were Coinbase and Gemini. Throughout the 365 Days of Forex series, most of the examples and ideas will be tailored towards the FX markets. Have the exact same techniques tend to apply to trading any other markets discussed in this episode and any future ones too. So guys, now you have a much more comprehensive understanding of the different types of financial markets that we have available to us. Why not hit that like and subscribe button so you can stay tuned for our next video, which will be covering the different types of trading. Cheers guys, and I will see you in the next one.